The Mortgage Bankers Association released their weekly application survey. It showed average interest rates climbing once again. But there is light at the end of the tunnel. They released their projections for 2023, and their expectations are for rates to decline rather substantially to the range of 5%. Let's jump into those details and get to the bottom line. Good morning. The MBA, or Mortgage Bankers Association, released their weekly survey, and it showed average interest rates climbing on the 30-year fixed-rate mortgage higher once again from 6.94% to 7.16%. That is the highest rate according to the survey in 21 years. This puts interest rates roughly 3.875% higher than the same time last year. Part of the survey data that they release also includes application data, and on an overall basis, which includes purchase and refinance application volume, applications are down 69% from last year. Purchase, specifically, when you isolate that, those are down 2% week over week, and that puts us down 42% year over year on purchase applications. On another related topic, on CNBC, Diana Olick referenced some information from the Pulte Group, stating that 24% of contracts were canceled in quarter three. So that sounds pretty alarming, like a very high number, but although that number has been rising, it is important to keep in mind that even in a very hot market, you're going to see roughly 15% contract cancellation. For those industry professionals, we understand there's various reasons that can occur, but it is interesting to note that that percentage is a bit higher in this most recent quarter than what we've seen in the past. Now, Jake, we got some other new data on the housing market, so why don't you jump in and tell us what you got?
Yeah, of course, Kyle. We've got a bunch of stuff that came in this week, so I'm really excited to dig into that. First up is new home sales. So this is the report that measures signed contracts on new homes, and that fell 11% in the month of September. Now, this actually was stronger than what folks were estimating, which was a 13% decline. That puts new home sales down 17.6% from last year. And from a supply and demand perspective, gives us about a 9.2 month supply of all new homes. But when you strip out homes that are not yet completed, you can't move in right away, there's only about 1.1 months of supply. So definitely very, very little supply there. The National Case-Shiller Home Price Index, which of course is known as the gold standard of home appreciation, showed that home prices fell 1.07% in the month of August. This moves the year-over-year appreciation reading to 13%, which is actually down from their previous reading of 15.6% year-over-year, which was in July. Now, most of the decline was seen in the larger cities like San Francisco, Seattle, San Diego, Los Angeles. When you remove those cities from the data, you're going to see that most of the markets were relatively flat. We got also the report from the FHFA, who has their own version of a home price index, and theirs specifically measures appreciation on single-family homes with conforming loan amounts. This is different than Case-Shiller because it doesn't include cash buyers or jumbo loans. And with that, the FHFA reported that home prices fell 0.7% in August, and that puts them, per their report, up 11.9% year over year. And finally, we got a report from Redfin that reported the average sales to price ratio is 99.2%. What that means is that when homes are priced correctly, they are moving fast, and there are not a lot of price reductions. They also cited in this report that 46% of homes are still receiving multiple offers.
Yeah, that's great stuff, Jake. Thanks for going over that. And it really illustrates the fact that the real estate market is not one-dimensional. You can't evaluate the strength of the real estate market or where things stand based off of one data point or one number. You have to look at the whole picture. So thanks for rounding some of that out. The last thing we want to dig into a little bit on this week's episode is interest rates and where they may be going next. So we have a couple of important pieces to cover there. One is going to be related to the Fed, because of course, we've been talking a lot about the Fed in this video series. They're always going to have a big impact on where mortgage interest rates are with their monetary policy. So the Fed has recently started to face some political pressure to stop hiking rates. Just this past week, Ohio Senator Sherrod Brown wrote a letter to the Fed chair, Jerome Powell, urging him to stop hiking rates and issuing a reminder that the Fed has two mandates: maximum employment and inflation, not just fighting inflation. He explained that monetary policy takes time to have effect and to reduce inflation, and that more Fed rate hikes will cause job losses. So this political pressure could lead the Fed to halt rate hikes after they execute on their next expected increases, which are expected in November and December. So something important for us to keep an eye on. That partly plays into this projection from the MBA, the Mortgage Bankers Association. We've referred to them a number of times. They're projecting in 2023 mortgage rates to decline relatively substantially to the range of around 5%. That would reflect a big impact and change in the housing market, and so it'll be important to see, where that goes. They refer to a lot of data and are a well-respected organization, but any projection for the future is somewhat uncertain. So interesting to see that we might be seeing improvement in rates and the effect that might have on the housing market. But of course, we'll want to keep an eye on some of the data points as we go along to see if we're heading in that direction or heading somewhere else. So make sure to stay tuned for next week's episode. We'll see you there and see you on the bottom line. Thanks.